You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thank you for tuning into Mining Stock Education. And in today's episode, you're going to be hearing a stock profile of Lithium Americas Corp. This company trades on the New York Stock Exchange under the ticker LAC. As a disclosure, I don't own any shares at the time of this interview. I have no business relationship with this company. However, my guest today is a fund manager, Chip Russell of Massif Cap, and his fund recently did a write-up and invested in this company. So Chip's going to be providing his investment thesis for why Massif Capital has invested in this company. Chip is a managing partner, and he's partners with Will Thompson, who has also been a previous guest from Massif Cap on this show. So Chip, welcome to Mining Stock Education today.
Thanks, Bill. Appreciate you having me.
Let's talk the lithium market. It's not something we cover so much on this show, but we do periodically when we have a specialist like yourself that understands it well. Provide an overview of the supply and demand outlook for the lithium market, let's say for the next 5 to 10 years, please.
Yeah, so it's interesting. I think we're at a point now in the cycle where, in our opinion, coming into 2021 and likely through 2025, we think the market is going to be quite tight from a supply standpoint, coincident with a real sort of rate of change differential on the demand side. And so if we think about and sort of just set the stage and provide some context behind this, coming into 2020 and sort of if we sort of plant a flag in March, so sort of right at that bifurcation of pandemic, pre-pandemic, we had about 300,000 tons of supply be either suspended or canceled as we went from sort of the 2017 price highs and enthusiasm in the market, followed by the sort of precipitous price drop. And we saw a number of the, again, planned supply come either offline completely, may never get built, and or be suspended. And so in our opinion, we think price has flatlined and sort of we've hit a bottom, certainly for carbonate. Again, coming into sort of the spring of this year, we started to even see some upticks in the hydroxide prices. And we're looking at an industry now that's growing at about a 15 to 20% compounded annual growth rate over the next 5 to 6 years. And so we're in a market environment now where we're moving from, roughly I think it's 20,000 tons of growth per year to about 200,000 tons of growth per year. And as you're likely aware, and your viewers are likely aware, the ability to bring on supply to meet demand can have a significant lag, right? So the notion of sort of when we receive the appropriate price signals such that new supply can be incentivized and sort of final investment decisions can be brought online relative to when that supply then successfully actually gets to market could be a multi-year period. And so as we look at sort of the demand profiles, and again, not based on forecasts, but really looking at the automaker sort of EV roadmaps and looking at the gigafactories that are, financed and under construction today. If we look at the needs of those facilities, we're looking at a situation where, the market is likely going to need to be pricing, carbonate and a hydroxide, and we can sort of get into the differentials between the two, between $10,000 to $12,000 a ton to incentivize certainly greenfield production and likely brownfield expansion as well. And so that to us is sort of the point at which the industry can hopefully sort of expand to meet then the demand profile from 2025 to 2030. And so again, we think we're at sort of this interesting situation where, yes, it's unfortunate that lithium is a very illiquid market. So we are going to see volatility in the price. But again, we're at a point where we think we've sort of bottomed, and the fundamentals, sort of the capital cycle analysis behind this, even though the demand forecasts are so robust, is quite appealing. So that's sort of where we sit today.
Chip, in preparation for this interview, I went back and listened to an interview I did with a fund manager in 2018, about 2 years ago. And in the course of that interview, we were talking about the EV revolution and what metals would benefit. And he was bearish on lithium, to where he thought that the lithium supply could be turned on quite quickly to counter any demand, and pointing even to what happened in 2017. Now, I personally don't know enough of the minutia of the market to argue point by point with you, but in general, what would be your response to that?
Yeah, I think it's factually incorrect to suggest that supply can be brought on quickly. And so, sort of case in point, and we put this out in our report. But if you look at the SQMs, the Albemarle's, and at the time the FMCs of the world, and we look at their planned capacity expansion from, say, 2012 to 2016. They hit about 50% of their target, and have consistently, and again, this is the majors, have consistently sort of fallen behind relative to expectations of bringing supply in the market. Now, the challenges of bringing supply in the market are a couple-fold, right? There's obviously just the notion of these are CapEx intensive mining operations by which it just simply takes time to bring these assets online. There's also some differences as it relates to if we plant ourselves in the brine operations of, say, South America. There's some the nuance as it relates to what's the relationship with the government, whether the government is actually allowing them to, in the case of, say, SQM and Albemarle, access the aquifers that then allow them to expand production, and whether they get held up in sort of a court situation as it relates to, again, property rights. And so, with the spodumene and hard rock producers in Australia, you might be able to pull and sort of quote unquote mine this resource a little bit easier than, say, brine. But then you have the issue of transportation and then actually shipping that up to, say, China, which is where all the chemical conversion is happening today, and the quality of that supply. And then lastly, sort of touching on the quality point, there's and I think a growing differential between bringing on, say, a lithium carbonate equivalent into the market, if you will, and a battery grade product, which is sort of getting increasingly stringent and being set by these auto OEMs, right? So the fact that, it is true that lithium is certainly a abundant resource, that is perhaps, the mining methods are perhaps not as prohibitive as some other mining methods out there for other metals and minerals. But the midstream processing and the ability to turn supply on sort of on a dime, I think is a fallacy. So I would disagree with that, and that's sort of predicated on just an historical observation of how the majors have performed over the last decade.
The Tesla share price has driven the price of a lot of lithium juniors in the past year. So do you account or do an analysis of where the Tesla share price is moving in order to determine where the price of lithium might go?
We do not. And that's an interesting way to phrase that, right? I think what the price of, we don't have a particular opinion on Tesla. We're not invested in Tesla at the moment. Tesla is a very interesting case study for a number of reasons, both within the world of electric vehicles and the clean energy, clean mobility movement, also within the world of public equity markets and how one should be valuing a public equity. So you can sort of bifurcate the Tesla story into those two stories, sticking with the sort of Tesla being a key sort of developer and very much pushing the boundaries of the electric vehicle movement and technology. I do think it has probably pulled forward other auto OEMs timelines and sort of research and development programs to put a foot in the door to the electric vehicle market. And so insofar as Tesla being there or not there, I think to its sort of broader competitors, it has very much pulled forward, I would say, that demand profile. With respect to Tesla's stock price, as it relates to the price of lithium, I think there is, at best, a very low correlation between those two. And I'm not sure that's even really sort of an appropriate dichotomy to sort of be tearing apart, if that makes sense.
Okay. Let's get to your stock profile, which I mentioned you would provide in the introduction. So your fund invested in Lithium Americas Corp. The ticker symbol, again, is LAC on the New York Stock Exchange. Provide an overview of your investment thesis. Why did you take a position in this company?
Sure. So we think Lithium America Corp today is the strongest junior miner lithium producer in the world. It's an advanced stage developer. It's bringing to market two world-class assets, the Tertiary project in Northwest Argentina and the Thacker Pass project in Nevada. The projects are at different stages of development, but we think that the resource base that the company has, the management team that the company has, and the sort of well-capitalized position the firm finds themselves in today suggests that we think it's going to be sort of this unique situation where within a sort of roughly 5 to 8 year period, we're going to see a pre-production mining firm become actually one of the majors within the industry. And I think that's rare and only possible sort of in this case as simply the fact that the lithium market and the lithium production market is not that big as today, and so the sort of rate of change for LAC to go from, again, a sort of development stage company to a major within the industry is quite compelling. We think the assets, sort of on a pure net asset value basis, simply at the price which sort of the marginal price at which new production needs to be brought online, we think the assets are worth $35 today. So it's a roughly sort of 200% increase from the price today, and the sort of delta between where we thought the price today and that $35 estimate is, we think, simply underwriting the ability for the company to bring these projects online. So the thesis or the investment thesis is not predicated on, say, an appreciating lithium price to the 2017 highs and or beyond. This is not a production company that we think is, say, fairly valued, and the sort of bullish thesis is an appreciating commodity price. We certainly have that sort of perspective on the market that certainly aids in our conviction in the thesis, but we think the assets as they sort of sit in the ground today, brought online, are easily worth $35 a share. And from there, we see some upside optionality, which we can get into. But again, we think it's a very sort of unique situation at a very sort of unique time in the market.
You've described the asset in Argentina as a tier one asset,
yeah.
But Lithium America has a 49%, therefore minority ownership.
Yep.
I understand they're in partnership with a Chinese company. Is this a risk to you, that the fact that they're not a majority owner?
No, I don't think so. I think actually their strategic partnership with Ganfeng is a value add. I think it's accretive, and I think the company's actually been quite smart and independent of, say, looking at the LAC's management team and looking at their backgrounds, right? John Evans, sort of former leading FMC's lithium division, et cetera. You can actually look at the decisions that the management team has made over the last 5 years in terms of how to actually capitalize the business to bring on two resources of this size and magnitude. And I think their decision to partner with Ganfeng is sort of a notch on the very good decision making, and in terms of how to actually bring these assets online. Ganfeng, in a
non-dilutive manner.
In a non-dilutive manner, exactly, right? So they previously, coming into this year, they were 50-50 partners. Ganfeng increased their ownership to 51%. I think it made sense for them to consolidate their balance sheet financially. They can access own capital in China and sort of bring it offshore. Economically, it doesn't change much for LAC, and they do have strong minority shareholder protection, right? So there is joint approval required for all major decisions, whether that's scope, size, quality. So LAC still very much is a strong partner in this. And when you have the strongest lithium producer in the world today, which we think is Ganfeng, double down on a project that has already spent, $365 million of the $565, about 81% of that's been committed, about 70% has actually been spent, and is to be mechanically completed shortly and turned on within the next 12 months. We certainly think it's value accretive. So I think their partnership with Ganfeng and the 49% interest ownership, as you noted, is a good thing. And we would expect the same likely to happen with Thacker Pass. We don't have any details on that matter, but one of the sort of interesting news flows that we expect coming into 2021 is how LAC finances partners, whether that's a joint venture agreement, et cetera, with the Thacker Pass project. And our expectation would be that the partner they bring on is value accretive. The other thing I'd say about Ganfeng too is that they have, and I don't have the exact numbers off the top of my head, but it's it's north of 90% of the offtake on Tertiary is committed at market prices. And again, so as a sort of pre-production asset going into production, the notion that you've got secured supply offtake as of even 18 months ago is
so
is
nothing's hedged. When you say that, you mean nothing's hedged, the market prices
Correct.
as they will occur in the future.
Correct.
Okay. What are some other risks here? When you did your opportunity risk analysis, what were the key risks you came up with?
Yeah, so I think I would say the primary risk is development risk, right? And so the bringing two large mines online is not easy, right? And so there is development risk. I think that's largely likely confined today to simply time horizon risk, right? Whether or not you think the firm can execute on, say, bringing Tertiary on in 12 months, or if it's a 24-month process insofar as the government of Argentina shutting it down again because of COVID and or not being able to get equipment in on site and or the processing facilities are not sort of operating to spec. And so the ability to have sort of operating at full capacity is delayed from, say, 2021 to 2022. So I think there's absolutely development risk. Certainly with Thacker Pass, there is more development risk, and I would say it's probably better characterized as production risk, only insofar as the mining at Thacker Pass is spodumene mining or clay mining, which is not technically unique, but certainly operationally unique within the world of lithium. So that deposit's been known for quite a while. Given the size of the lithium market, it's never been economically interesting to bring online, but the development that they need to do at Thacker Pass from the processing standpoint, right? So they know how to get the clay into a lithium sulfur, but then to make that into a lithium salt, either hydroxide or a carbonate, has been done at sort of at lab scale, but they need to execute that at sort of pilot project scale and beyond to sort of really hone in on, say, what a DFS is going to articulate as it relates to the grade coming out of there and the costs associated with that. So development risk is really number one. And then obviously number two is market risk. This is, I would say, second to development risk, only insofar as the discount to what we think its intrinsic value is predicated on these assets coming online. But insofar as we have a situation in the either EV market and or sort of demand profile or supply situation of the lithium market where prices stay south of $7,000 a ton for carbonate or hydroxide, that could be problematic for the ultimate value of the business. We wrote a white paper in the spring of 2019 on sort of the risks and opportunities within the battery supply chain. And one of our sort of conclusions from that was that the EV automaker roadmaps are actually likely going to be delayed, not because of the ability for the auto OEMs to execute on their plans and or consumer interest, but simply because not enough supply is going to be able to reach the market. And so we might have situations where tight supply actually leads to an auto sector that needs to tamp down their demand profile or expectations as it relates to actually bringing new vehicles on the market, which then has sort of a circular feedback loop as it relates to how fast the sort of, ultimate size of the market is reached, right? Whether it happens in, right now, a lot of these growth expectations, if you look at sort of the benchmark mineral intelligence or the Bloomberg New Energy, finance reports, are really looking at sort of a 10-year period before we hit kind of a point at which EVs become, roughly larger than 50% of new cars being brought onto the market in any given year. Not total cars on the market, but new cars being brought onto the market. The notion that we hit that in the next 10 years, as opposed to, say, getting stretched out to 2035, is unclear at this point. We don't have, strong conviction in that sort of end flagpole at 2030. And then obviously, if you extend that out, that has sort of downstream implications to sort of what the demand ramp looks like leading up to that. So, interestingly enough, supply situation or lack of supply or challenge to actually meet expected demand in the near term could actually lead to auto OEMs sort of revising down what they plan to actually bring onto the market, which again sort of has that circular feedback loop. So risk number one, development risk. I think that's really sort of key to close that price differential between the roughly, I guess, $10, $12 we're seeing in the market today relative to our $35 share price. The time it takes to get to 35 and or what the ultimate value upside from 35 is to say $80, $90 price, which again, sort of is predicated on either pricing multiples and sort of an options analysis. That's probably going to be driven by the market, the health of the market, the liquidity in the lithium market, et cetera.
What's your share price target for when the company actually starts to produce cash about a year from now or so?
So we think a $35 target is realistic by 2024, 2025. So if we're talking, the beginning part of 2022, it's not unrealistic to think that the company is trading in the mid 20s, and or if it's already producing cash from Tertiary at that point, and let's say Thacker Pass is sitting in early 2022, a year out from production, it's not unrealistic to expect that they could be trading in the low 30s at that point.
I asked you about how Tesla affects the lithium market. Now I'm going to ask you about how stock picking YouTube channels and traders influence this share price of LAC, because it seems to be a darling. As I just did a preliminary YouTube search, there's a lot of people talking about it and recommending it for trading purposes. Do you analyze that at all?
We don't. That particular aspect of it, I don't think we analyze. We are very conscious and perhaps have a growing interest in how the market structure is going to affect the equity. And so what I mean by that is looking at the owners of the business, the sort of capitalization of the business, the shares outstanding, how much of that is free float, who owns those shares and why. I think is a very interesting and important analysis in this day and age, as we're seeing the total percent of passive, sort of non-price sensitive actors in the market increase. So as an example, if we're looking at, say, a Lithium Americas Corp, and we're looking at the company back in early 2020 when it was $2, $3, $4 a share and a few $100 million market cap. And at the time, management owned a good chunk of it. A Thai oil company that provided financing in 2017, which has now just exited their investment. At the time, they owned close to 15% of it. And Ganfeng had a large minority interest in LAC, in the equity of LAC itself. And so if we look at, say, for instance, a $300 million market cap company that has, let's call it, 65, 70% of the total shareholders are either not selling and or not price sensitive, either because of, say, a passive investment vehicle, and or we know that they're a strategic shareholder that isn't interested in selling within the next 12 months. The opportunity for, say, retail or retail speculation to have an outsized impact on the share price goes up probabilistically, right? So if the all else equal, the stock price becomes more inelastic, and small changes in daily flows or monthly flows, however you want to articulate it, can have an outsized impact on the stock price. So I would say, as it sort of getting back to the original question, as it relates today, I don't think LAC is necessarily in a position where the speculative nature of some of the YouTube videos or passion around this, or some of the this is another sort of battery company that's going to ride the coattails of Tesla. It's not clear to me that those flows or retail flows are going to have an outsized impact on the company's share price today. I will say that, for instance, one of the passive ETFs that LAC finds itself in today is weighted based on free float, meaning the larger amount of free float a company has measured by this particular index and ETF, the larger percent share it has within that passive investment vehicle. We do know that as one of their strategic investors at the time has exited the position of LAC, they've effectively taken down their 15% stake down to probably sub 5% stake over the last 2 months. We do believe that the free float of LAC has actually increased such that their percent within a particular passive vehicle may be actually increasing in 2021. So we actually might be seeing larger passive flows or larger non-price sensitive flows into the equity. And so in our report, that is sort of one of the 4 to 5 catalysts that we think is sort of interesting as you think about this equity from a market structure standpoint. But we don't really place much weight at the moment on the sort of retail investor and or speculative nature of some of the sort of day trading and or sort of YouTube phenomenons that have sort of bubbled up over the last year. We love the passion; it's fantastic, but it's not clear that it's sort of on the margin important for this investment thesis.
So my last question, the volume we've seen in the stock in December, and in particular from the 21st to the 28th, this company's on the New York Stock Exchange, yet it rose 50% in 1 week. So what was your analysis of what was going on there?
We haven't actually looked at that very closely, so I can't give you a very good answer. I think, it's interesting. We had quite a lot of, it's very possible that, they've started to receive more passive inflows. It's not clear to me that's the case, though, because a lot of the ETFs are going to be sort of rebalancing on a quarterly or annual basis. And so I don't actually, as I'm sort of saying this in real time, I don't actually think that that's necessarily the catalyst for that. So I don't have a good answer for that. Although I will say, increased volume and increased liquidity is certainly a good thing for a company that's well capitalized going into, again, sort of T-minus 12 months from seeing actually an income statement reflect the value of the assets that are in the ground right now. So increased volume is good. I don't have an explanation for sort of that 50% turnover as you noted, but it's going to be interesting to watch.
Chip, your website is MassifCap.com. I'll put a link in the show notes. Is that the best way for someone to get in contact with you if they want to reach out?
Yeah, best way to get in contact. Thanks, Bill.
Okay, excellent. All right, MassifCap.com. I really appreciate this overview, Chip. Thank you very much.
Thank you, Bill. Nice speaking with you.